when you want to run hot is when you want to let your heat grow and let your open P&L grow, because you can get the potential very large return. The con is if your timing is off or the rally doesn't continue, you are going to give back a lot of open P&L. When to cool off, sell as a strength or smaller initial size and trades. The rally has been going on for several months. So pros, you can reduce potential drawdown if the rally fizzles. Con, of course, if the market continues, you miss out on potential gains. So, and the ways to reduce heat or open P&L, you cut positions, raise trailing stop losses, and you stop initiating new trades. When the trades work in my favor, I increase the risk, 0.75 up to 2.5% risk per trade. That's total equity risk to account. Then the larger size is when all the stars align. That is not a frequent size. That's on a A+ setup when I have traction in my portfolio. And you have to trust that sooner or later you will be trading well in a good market. And then all you need to do is connect with a few trades. You're up for the month, and then you can really ramp up the aggression and get really aggressive. And you don't want to start ramping the aggression when you're already drawing down. You only want to ramp when you're winning. So much of the game is surviving till you get a time, an easy money environment where there's, 50 stocks that are up 100, 200% in a year. And all you have to do is catch a few of them with decent size, and you can have a fantastic return. I personally have never come back from a large drawdown in a month, but I have made the drawdown much worse. And I have had multiple losing months in a row. In hindsight, going back and looking at my results, I realized that I'd be much better off just cutting the losing months short, slashing risk, and limiting risk going forward.
All right, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion Conference, someone who I'm really looking forward to hearing from, Christian Flanders. Chris is a swing trader and top performer in last year's U.S. Vesting Championship with a return of over 400%. He's competing again this year and doing very well in the Money Manager division. And today he'll be focusing on one of really the most important parts of trading, and something that I think takes a little bit to grasp, progressive exposure. So I think this will help out a lot of traders out there. Chris, thank you so much, first of all, for taking the time. And thanks so much for being a part of the conference. I appreciate it.
Thanks, Richard. It's an honor to be presenting. I've watched this every year since its inception, so it's pretty surreal to be a part of it. It's wonderful. Thank you.
Well, of course, it's great to have you. And let's dive right in. And first things first, I think this will be a great topic, and excited to dive in on progressive exposure.
Okay, yeah, great. Let's do it. Progressive exposure, the key to consistency and longevity in trading. So the big thing with trading is, your goals. What are you trying to achieve, and why are you trying to achieve them? And this is very important because, there's a ton of adversity that you're going to have to overcome as a trader. So it is very important to have a very powerful why to keep you motivated when the going gets tough. For me personally, I had 3 years in a row of drawdown, and what kept me going was the desire to provide for my family, and how much trust my wife put in me to quit her job to give me a chance to make this happen. So that very powerful why, and that kept me through the tough times. What return are you aiming for? What drawdown can you tolerate? And what are you willing to sacrifice to make it? These are all very important questions, which are key as we move forward through the presentation. Okay. Albert Einstein didn't actually say this, but I thought it's still a very powerful quote, and something that you need a big brain to think about. But compound interest is one of the most powerful things in finance, in the world, really. And if you understand it, you can harness its power. So here we go. What's the rush? So a lot of beginner traders, and I was guilty of this too, are in a very large rush to make their fortune. You see the potential, you see the kind of numbers that amazing traders can put up, and you think, I want it right now. Well, if you look at the results of great returns, what happens over time if you can maintain a high compound annual growth rate, or a CAGR? Morgan Housel, earlier, he had a great presentation about the dangers of trying to make too much money too fast with leverage. And I think this goes to show how much money is possible with solid returns and using the power of time and compound interest. Warren Buffett has a great quote on this, why he's so successful and why more people don't emulate him. And he said that no one wants to get rich slow. Everyone wants to get rich fast. So you can see the returns, a 20% return, 25% return. After a decade, after 20 years, after 30 years, the returns they're mind-boggling. It's hard to even comprehend how big those numbers can get. And then you see, some market wizards like, Mark Minervini compounded that, 150% for 5 years. Qualamagi has compounded for, I believe, 100% over 10 years. You can imagine how big those numbers get. Okay, and this is a slide just showing what a big losing year can do to your total return and how it affects your CAGR. So in the first example, a trader, 250% years back to back, fantastic numbers, mind-blowing numbers, right? Year 3, minus 50%, and you see that the total return drops to 12.5% and the CAGR drops to 4%. So this just shows how, ideally you never have a losing year, but I've had losing years, they happen. The goal is to keep them as small as possible, to not reduce your CAGR. So boom and bust, the killer of compounding. Charles Harris had a fantastic presentation on his YouTube channel. If you're not familiar with him, I highly recommend you watch it. But the bust is what kills compounding. Having the big down years, the big down months, really remove the power of compounding. So I have here, this is actually from a trader from last year in the USIC Enhanced Division who showed his results. A fantastic year-to-date return, but what a ride to get there. Not a ride that I would enjoy. I don't think he enjoyed it either, but he got to the other side. But you run a lot of risk with those kinds of monthly drawdowns. So how can we get off that roller coaster? Having rules, the discipline to follow them, progressive exposure, and then what I call a heat check. And so progressive exposure is, I didn't define it at the start, but it's basically trading with larger size when you're winning and reducing size when you're not. That's really it in its simplest form. So here's a great Livermore quote: "A loss never bothers me after I take it. I forget it overnight, but being wrong, not taking the loss, that is what does damage to the pocketbook and to the soul." So he's one of the greatest traders ever, and maybe the biggest boom and buster ever, going to $100 million fortune to bankrupt. To I'm sure he ran it up, I think 3 or 4 times. So he is probably the ultimate boom and buster, and that $100 million adjusted for inflation is over $1 billion as an individual trader. So the struggle with accepting losses is a recurring human phenomenon. We are all guilty of this, or it's ingrained into ourselves. Loss aversion, we feel a lot more pain from losses than pleasure from gains. I'm definitely guilty of that. Maybe you are too, Richard. The losses hurt a lot more than the gains. And then the sunk cost fallacy, which is you're reluctant to abandon a strategy or course of action because you've already invested so much in it, even when it is clear that the abandonment would be more beneficial. So I have a story about this, or a story, but just an analogy with poker, that if you play poker live for long enough, you get a good idea of the kind of opponents you play against. So there's one kind of opponent called the rock or the nit, and he only bets when he has it, especially on the river. If he makes a large bet, he has it. He has very likely the best, he has the nuts, he has the best possible hand. You know he has it. He knows he has it. The table knows he has it. The guy who is about to call him knows he has it, but he just can't let it go, because what if he doesn't have it this time? And of course he does have it, and he loses his money. So the sunk cost fallacy of already putting so much into the pot and then being unable to fold. So a sign of a professional in poker, a strong professional, is the ability to fold extremely strong hands with extremely high absolute value when they estimate the odds of it being good are not high enough to justify the call. So if you have the second nuts and a player that only bets with the nuts bets into you, strong players can make that fold, but amateurs would not be able to relinquish their hand in that example.
And just to jump in, Chris, do you want to mention a little bit about your professional poker playing background? Because some people watching this might not be familiar of like how you made that transition from poker to trading. Just very briefly, yeah.
Sure, yeah. So, I played, let me scroll back really quick. But I played, I should have started with this, but I played online poker for about a decade professionally before I transitioned over to trading. And I played primarily online, 99% online, but a little bit live. And online you're staring at a computer screen. It is much more mathematical, I guess you would say. But the few times I did play live, you see crazy stuff. I mean, you see guys, lose a hand, turn, they get visibly red, and they just start playing every hand blind. Blind is you don't look at their cards. They would just start playing every hand. I mean, you see wild behavior. And you see it in financial markets as well. When market participants are clearly, when the fear gets really high, you can see it in the price action, the way prices move. But yeah, I played poker for almost 10 years professionally before transitioning over to trading. So we'll.
Yep. Also, I think worth mentioning because I've got a lot of I've got some questions about the analogies between progressive exposure in the markets and how that comes from maybe some poker player mindset too. But yeah, I'll let you keep going.
Okay, sure. So learning to take losses. So learn to take losses. The most important thing in making money is not letting your losses get out of hand. So I got to speak with a veteran trader who's been in the market since the 1980s. I mean, he still draws charts by hand. And even he still struggles with taking losses. He was telling me how his biggest regrets or his biggest mistakes are not taking the losses when he knows he should. He's more of a research and fundamental guy, right? So if he believes in the story, if he has conviction, he's going to try to let it play out. And that's resulted in some gut-wrenching losses and drawdowns. Drawdowns. So his thing to me was, discipline. Take the losses while they're still small and get out, because he's had to learn the hard way, and I have as well. Drawdowns cannot be controlled without taking losses before they become large. Everyone has losing trades. How you handle them is the difference between average, good, and great returns. And then Mark Minervini just posted this about 5 minutes ago, but I thought I'd include it about the reality of controlling risk. And that if you don't feel like an idiot, you're not managing risk, because you are going to get stopped out often and have the stocks turn back around and go up. And that has happened to me countless times, and it continues to happen to me today. I've been in almost every leader in this rally, and I got knocked out of a lot of them. And that's part of the game. You have to get used to it and not go on tilt and just pull your stops, because eventually you will take a very large loss, which I have as well. Okay, so yeah, drawdowns are inevitable. They will always happen. The key is keeping them as small and controlled as possible. And Mark Minervini has a great story in one of his books about how he went back and looked at his trades. If you remove the large losses, his results would have been fantastic. So going forward, he said, I refuse to allow any more large losses. If they get me, it's going to be death by 1,000 cuts. So here we go, death by 1,000 cuts. So I Googled this because I didn't know what it was from, but it was a form of execution in China, which involved, it wouldn't take 1,000, but these small cuts that would be extremely painful, and eventually result in death. But thankfully in trading, you will not die from taking a lot of small cuts. You can survive and give yourself time to adjust, to learn, to adapt, and evolve. And this is a feature, it's not a bug, it is part of the game. The drawdowns are part of the game. You will be in a drawdown, if you trade the way I do at least, swing trading, you will be in a drawdown most of the time. The making new equity highs is the rare part. The drawdowns are really what's common. And decapitation, one large loss can be fatal. I've met many traders that have had the one large loss wipe them out. I've had traders where they've had one loss take out multiple years of gains, one large loss. I've had traders who have large accounts lose it all in one trade, one large loss. So, I have taken a large loss, and after that, I said never again. I'm never going to let that happen again. So the only way to prevent a large loss is you take the loss before it becomes large. So personal journey. Trade is an extremely personal journey. What works for one trader may not work as well for others. You have to find out what works for you. So it took me 7-8 years for all of this to click. And by now I have a pretty good idea of what my strengths and weaknesses are. And the way I use progressive exposure, it's really to protect me from myself, because I get overly aggressive and I will overtrade, which is a weakness that I continue to work on. But hopefully this can help you think about what your personal strengths and weaknesses are and what you can do to highlight your strengths and reduce or hide your weaknesses as much as possible. So strengths and weaknesses. So risk, the double-edged sword. My strength is the ability to put on risk and aggressively pyramid as trades work in my favor. And my weakness is I overtrade and I place a lot of risk on quite quickly. So if my timing is off, I can get hammered pretty fast. So how do I protect myself from myself? Default position size, 0.25 to 0.5% risk per trade. That's much smaller than I used to trade. When I would have very large drawdowns, I used to trade much larger. So I've reduced my initial position sizing. And when the trades work in my favor, I increase the risk, 0.75 up to 2.5% risk per trade. That's total equity risk to account. Then the larger size is when all the stars align. That is not a frequent size. That's on a plus setup when I have traction in my portfolio. And then the max monthly loss, I try to keep my losses at a maximum of 5%, and I will reduce risk for the next month if I have a negative month. And you never ever want to have cascading growing losses monthly. That is key. That's how you can enter a trader death spiral, and that is a very unpleasant thing.
And sorry, just to jump in, I think the last time we did a podcast, Chris, we talked about that quite a bit. That was what one of your focuses going forward is keeping those monthly drawdowns as small as possible. Any kind of with that added experience now since the last time we talked, how's that been going, and how's that kind of helped you both protect your equity but also protect your mindset as well, so you're mentally ready to profit from the better periods in the market when the market cycles eventually shift back to an uptrend?
Right. So it's helped immensely. I have kept my monthly losses to 5% or less. So I have not gone into a large drawdown this year. It's been very controlled. I think a lot of guys, it can be frustrating at times because the market's been very bullish since the lows in April, right? But what if you are not trading well, but you see the market taking off with you? Well, that can be difficult. There was a stretch where I sized large on a few trades and had 4 losers in a row, and I immediately slammed the brakes. Even though the market was positive, I reduced size, because if you continue trading large because of the market, you run the risk of a drawdown. The only way to stop the large drawdowns is you must cut size if your trades aren't working. And I cover that a little bit later, but basically, if you're not winning, there's no reason to maintain size. You have to stop. You have to cut the risk. That's really it's the only way to protect yourself. And you have to trust that sooner or later you will be trading well in a good market, and then all you need to do is connect with a few trades. You're up for the month, and then you can really ramp up the aggression and get really aggressive. You don't want to start ramping the aggression when you're already drawing down. You only want to ramp when you're winning, and then you can get really aggressive. I've been helping a friend trade, and he gets, I would say it's too aggressive, really. He's risking 4 or 5% of his account, but he's up so much now, and it's okay. If he's willing to stomach the drawdown, which eventually will come, you can be really aggressive. I'm fine with extreme aggression when you are winning and you have the profit cushion. You just don't ever want to do that when you're losing.
Yeah, perfect. Sorry to jump in, but I thought that was a good thing to talk about.
So so for max loss, at 0.5% risk per trade, you need 10 losers in a row to hit minus 5%. And at 0.25% risk per trade, you need 20 in a row to hit minus 5%. So I've personally had 20 losing trades in a row. I've had more than 20 losing trades in a row. So it seems crazy. You think, how can you possibly lose 20 in a row? Well, that's what I used to think too. And then I would increase size at the end, because there's just absolutely no way I can lose 17, 18, 19, 20. And then it would happen. And then the drawdown would get worse. So when I start losing, I cut the size, and that's what really keeps the drawdowns in control. So after a losing month, I will reduce the maximum drawdown allowed for next month. So the first month maybe -5, -3, -2, -1, -0.5. So if you have 12 consecutive months of losses following this principle, you'd be -15% for the year. So I've never had 12 months in a row of losing. I've had 4 or 5 in a row, I believe. But yeah, I mean, so if you were able to follow this, you know that your annual loss could never be, maybe 15, maybe -20, right? But you keep it, reasonable. It's recoverable. You really don't want the -50, -60, -70% drawdowns, because those are extremely difficult mentally to recover from, but also just mathematically. Once you're down 50%, I mean, you need a double to get back to even, and at -70%, you need 150. I mean, you need a large gain to get back. And I have done that. I have come back from a 65% drawdown, and it was not pretty. I would not wish that upon anyone. And this is a way to prevent that from ever happening. And if you ever do go through that and manage to come back, at least for me, never ever want to have that happen again. Never ever. So and this is the only way that I know of to prevent that from happening. So yeah, portfolio trash. So once you're winning and have profits, you can increase position sizing if you so choose to push size, risk, and return. And if losing, cut size, cut risk. So like I said with my friend, he's always asking me, is it too much size? Is it too much size? I'm like, look, you're in the green, you're winning. You have the green light. Once you're winning and the market's good, you have the green light to get as aggressive as you want. Really, it's just once you start losing, you must aggressively cut size. Okay, so monthly progressive exposure. So what controlling drawdowns can do for your results, the power of compounding. So I took the trader from the USIC enhanced division and showed what happens if you were to cap his monthly losses at -10%. And I also reduced his positive months by 10% because maybe he has to be a little more cautious in general. And you can see the year-to-date return more than doubles. And then if you're able to just keep the monthly loss control to -10%, you can see the year-to-date return is out of this world. I mean, a 300% return. We take for granted the ability to have a stop loss. So I got to speak with him on the phone. He works at a financial institution. So he has to pre-check all of his trades. So he cannot trade without approval. So before he puts a trade on, he has to send it to HR, and they approve or disapprove the trade. So you cannot have stop loss. So Minervini has a great quote about driving not having stop losses is like driving a car without brakes. Sooner or later, you just can't stop. So still impressive returns without using stop losses, but. We had a conversation about that, but he's adjusted since then. My experience. So I personally have never come back from a large drawdown in a month, but I have made the drawdown much worse, and I have had multiple losing months in a row. And in hindsight, going back and looking at my results, I realized that I'd be much better off just cutting the losing months short, slashing risk, and limiting risk going forward. If you're drawing down, it's likely the market is either negative, your timing is off, or you aren't seeing the ball clearly, or a combination of all three, maybe one or maybe two. Earlier this year, the market was great, but my timing was off, so I cut size, and then a few winning trades in a row, you see your A+ setup, you size up, that's a winner, and you're back in business. You can go back to being really aggressive, that's how to keep the drawdowns controlled. So study market history. The bull markets, they always come after bears, they always come back, and the opportunities are immense. And I wanted to refer to my Evernote where, some years I'll have, 50, 60 studies of previous market winners. Some years I'll have 2 or 3. So, are there always opportunities? Yes, but some years you're flooded with them, other years not so much. So much of the game is surviving till you get a time, an easy money environment where there's, 50 stocks that are up 100, 200% in a year. And all you have to do is catch a few of them with decent size, and you can have a fantastic return. So here you go. So portfolio heat. So risk versus heat. Heat, how much equity you lose if all your stops are hit. Risk is how much initial equity you lose if all your stops are hit. So I have a few examples here, just showing the difference between risk and heat. So heat basically includes your open P&L, while risk is just the initial account risk. So the heat check, if all my stops hit, what's the drawdown? That simple. So that includes open P&L. So I mean, you'll see traders post about online about how they want to take profits. Why? Well, because the heat is too much, right? I mean, I've had times where the heat is like, well, last year the heat at one point was almost the entire the entire account practically. I mean, I was up 100% in the portfolio. I mean, my heat was massive. So are you okay with that? Because that's the potential drawdown. So when to run hot. So this is very important. At the start of rallies, much easier said than done. But when you want to run hot is when you want to let your heat grow and let your open P&L grow, because you can get the potential very large returns. The con, of course, because everything in trading has a drawback for the most part. The con is if your timing is off or the rally doesn't continue, you are going to give back a lot of open P&L. When to cool off. Sell into strength or smaller initial size in trades. The rally has been going on for several months. So pros, you can reduce potential drawdown if the rally fizzles. The con, of course, if the market continues, you miss out on potential gains. So and the ways to reduce heat or open P&L, you cut positions, raise trailing stop losses, and you stop initiating new trades. So this is really key. This is a combination of situational awareness, experience. It takes time to know this, and often there'll be false starts. I mean, this rally just took off from the lows, but sometimes you'll have multiple waves down, and on each bottom or what appears to be a bottom, you'll have stocks set up and break out, and they will suck you in, and then the rally doesn't materialize, and they will sell off, and you will give back. So this is really like the art, I would say, of trading. I mean, you can mechanize this. I mean, you can have specific rules, but a lot of it is, at least for me, it's more feel.
Yeah, can we pause on this slide, because I think this is so good, and I think and I struggle with this. I still working on it, but I think there's a lot of traders out there who they miss the start of the rally, and they feel pressured. The index is going up, and they feel pressured, and then they push size or push entries that maybe the leaders already extended, but those are the ones that are the leaders, so they need to get in them. They enter at the wrong spots, get shaken out in natural reactions, and then they've got a drawdown to start, and then they push size again to try to get back. It's like a cascading series of events where if you don't start getting exposed and testing positions a little bit earlier, when yes, the trend is less clear, but maybe that's the proper time where you can get maybe tighter entries and actually try to get into 1, 2, or 3 leaders that, if you get into them properly, can ride for the trend coming out of it. But I think this is such a great slide. And just again, speaking from personal experience, I've struggled with this, and like you said, I come up with kind of more of a system, some kind of rules-based approach where the first high or low, I have to start testing some trades as we push off that first high or low, or right near the 21 EMA. If we start taking out that 21 EMA, that's when, for my style, for my system, I need to starting to buy positions if I haven't already. Because if I've missed that in the past, again, I'm in kind of that slippery slope where it doesn't create good trading habits. So this is such an important concept, guys. I think especially if you're newer to the game and haven't gone through a few market corrections and strong rallies from them, you can't, like Christian said, it's hard to internalize. You do need some experience, but this is so key, guys. And this is a great slide to summarize it. So fantastic, Christian. Anything else you want to add on this slide based off what I just said, or your own experience with it?
Yeah. So I actually spoke about this there was a YouTube or a talk I had with a few traders the other day about how, like, the 2019 rally, that was a fantastic rally. I was probably on average 150% long the entire way up, and I was down 30%, doing exactly what you said, buying every rally or every I miss the initial leaders, I chase, the market pulls back, I get stopped out. It rallies back up, I buy, literally buying the high, selling the low the entire way up the rally. So no, I've been there. I've made every mistake you can make But I mean, and that's the point of this of progressive exposures. It gives you the ability to survive the mistakes, survive the learning curve, and make it to the other side. And that's and yeah, I mean that's why this is so key. That's why this is so key.
And was that that period where you were 150% long and actually suffered a drawdown? Was that coming out of the 2018 correction, or was that at the end of the year, coming out of the choppy summer period?
That was coming out of the 2018. That was coming out of the 2018, like I think end of year sell
The
off.
inflation,
Right. Yeah.
yeah.
Yes. And I remember there was a few names, Kron, which was like a marijuana stock, and then SE, which I covered in our interview before, where I watched the episodic pivot go, and then tried to get into the flag like 5 times or however many times, and each time I increased my size. Right. The first one, I was like, oh man, this is like so great. 1%. Oh, it didn't work. Okay. Next. Oh, this one has to. 1.5. Oh, that didn't work. Okay, next one. 2%. Oh, that didn't work. Oh, next one. 2.5. And then it's like, whoa, like this drawdown is big, and it only took me 4 trades, and that doesn't include the other. I had some winners, of course, but same thing with Kron. That looked like it was forming a power play, which eventually failed. It didn't work, but I sized like 3 or 4 times into that one as well. And before you know it, you're down 20%, and it's like, okay, well, what do I do now? So you just never want to get in that position where you're in a good market, but you handcuffed yourself because you put on too much size and drew down. So even if you're very bull, I was very bullish, but it doesn't matter. You just cannot allow those drawdowns. So you have to control the size. And and once you're winning, once you have a few names work, you can ramp. There's no rush. I mean, it's like the first slide. Like what's the rush? If you can make 30% a year for 10, 15, 20 years, I mean, the numbers, I mean, you're going to have more money than you can spend. I mean, the numbers get so large. So it's really about the patience and not seeing the forest, not the trees. Like you're in the middle of a forest, you're surrounded by trees, but it's like, yeah.
Yeah, hit some singles before you try to start swinging for fences.
Exactly.
Yeah, awesome, fantastic.
So simple, not easy. That really sums it up. It's simple, it's not easy. It requires incredible emotional control, self-awareness, and great minute. Everyone wants to be a market wizard until it's time to do market wizard stuff. Well, market wizard stuff is sometimes if you're not trading well and the market's taking off, you have to slow down. It's the hard, but you don't want to slow down. You want to make the money back right now. You want to make the big gains right now. You see everyone making a huge amount of money, and you're the one guy in the world that's not, which of course is absurd. I promise you, there's tons of traders that have gotten chopped up and missed the rally. I mean, that's me. I mean, I've been at that multiple times. It always looks easy in hindsight. Real time, managing risk, trading. It's fog of war. In hindsight, the generals, it's so obvious what they should have done, but in real time, with limited information as well as the emotions, it's very difficult. I have a friend, my friend and my mentor. He would tell me that he wouldn't want to record his trades because it would show him the mistakes he made. It was like looking at a mirror, like a reflection of yourself, right? Your equity curve, the trades, everything. It's a reflection of you, and he didn't like looking at it. But the solutions are so simple, right? It's an extremely humbling experience looking at your mistakes, and a lot of guys, this is a thing with poker. Poker players have massive egos, like massive egos. I mean, I know some traders do. I think trading is much more humbling than poker. I mean, it's not even in the same universe. I mean, because with poker you can always blame the deck. you can always. I was.
You can blame the market too, though. But yeah.
Yeah, you can blame the market, but it's different. I mean, it's different. If you play both for a while, I've met so many poker players with just these massive egos. I have not met many traders, at least that have been around for a while, that do, simply because trading is so humbling, right? Trading is so humbling, but with poker the variance is so wild, and because it's a one-on-one, or I mean, you're playing as other players, but you're playing as other players, right? It's more of it's a relative skill game, not an absolute skill game. So as long as you play with worse players, you can win. But trading's not quite so the same. Okay. So discipline. Yeah. Have rules, stick to them. Sacrifice short-term mental comfort for long-term goals. Let the power of compounding work for you. So yeah, so those slides. I mean, compounding. That's really that's the most powerful thing you can do. I mean, that's the magic of trading, is the ability to compound over time and let your money grow and let your money work for you. And then I hope you guys found that helpful. I'm on Twitter at cflanders7, and yeah, that's it. I think that was only 40 minutes or so.
It's all good. We've got some questions to talk through. So, Christian, first of all, thanks for that. I think this is so important, this topic. And the first question I had for you is, you talk about, slowing down when things aren't working for you. How many trades would it take for you to say, okay, my trades, whatever the market's doing, whatever everybody else is doing, I'm not trading well, or I'm not seeing the ball well right now? How many trades would that take to, drop from risking 0.3% to, maybe having that, or whatever your process is?
Right. I mean, 2 to 4. I mean, it depends on the market environment. I'm not in every breakout, although sometimes you wish you were, but I'm not in every breakout, right? So I'm watching the market and seeing what names are working. Are things going up? Are things going down? Is there general market weak? I'm looking at everything. So it's hard to really give a definite answer. But if you lose 3 or 4 in a row, I mean, obviously it depends on the quality of the trade. I mean, I'm guilty of overtrading, so I take trades that are not A setups, right? So if those don't work, it's less meaningful than if your best setups aren't working. But yeah, I would say a few trades, 3-4 trades, and I'm probably going to be cutting size.
And is it similar on the flip side? Because that's equally important when a correction just happened, you're starting to test trades. How many does it take you to ramp up size to normal?
Again, you're looking at everything. I mean, you're looking at what the market's doing, what leaders are doing, what sectors are performing. But yeah, I would say it's, if you have a few trades that are working and then you get an A setup, then I'd size for that one. And if that one works, that's like a big green light that, okay, the market's working, they're rallying, I'm seeing the ball, you can really ramp aggression at that point.
Excellent. And maybe using a case study of this most recent correction this year, and maybe from a holistic perspective, also like noticing which stock to try. Coming out of this correction, around when were you starting to test trades, and how did you kind of pick the ones to give a shot in the first place to see if the market was rewarding your style?
Right. So I I was very fortunate that I actually was in the market basically at the lows, and I screwed up a lot of those trades, but I was able to avoid the sell-off. And then when you had the cascading increasing losses on the indexes as well as individual stocks, I was paying really close attention to names that were still in intermediate term uptrends, like a Palantir or a Hood or a Spotify or Netflix. So I tried Netflix. When it broke out of the double bottom, it undercut the low of the day. I got knocked out, and then it took off, and I missed it. I tried getting in Hood on the second day off the lows, and I got stopped out, and that took off without me. I got Palantir on the day of the lows, and that one just went higher. I was able to ride that for a bit, and I also bought Hughes, the NASDAQ on the lows, and I panic sold that like 7 days later after that massive one up day. I was like plus 12%, and the next day was like down 7%, and I think I sold that basically at the lows. Yeah, I mean, I was able to get in. Palantir really allowed me to take a lot of trades, and then the next, I want to say, week or two, it was extremely volatile and choppy, and I think I lost pretty much every trade I took. When the market was basically just chopping around the moving averages. And then when Palantir formed a double bottom and gapped at like around 99, I sized up for that one. And that gave me the cushion to keep going. And then I posted on Twitter that I was extremely bullish on CoreWeave, that it was just like eBay in 1998, like a new, eBay was like a new internet stock, IPO'd right before a brutal bear market. CoreWeave is a new AI data center play, IPO'd right before bear market. It sold off, or it rallied, and it sold off during the bear. I bought it at the lows on April 7th. I got knocked out. It went lower. It came up. It formed a little pivot. It gapped up out of that. I bought it. It stopped me out. I took the opening range high. It stopped me out, and then it just took off and I wasn't able to get back in. And then on earnings, I tried buying it. After earnings, it was gapping after hours. I bought that. It stopped me out. The next day, what did it do? I think it was rallying. I took it over the 1 minute opening range highs. I got stopped out. At the end of the day, it took out the highs. I didn't buy it back because at that point I had taken so many losses, and I was sizing, trying to put on, because I had a lot of conviction in the name. I was trying to put size on. So at that point the losses were so large that I was like, geez, I can't put on the size I want. It's just not responsible for me to continue trading like this. So I'm going to back off. And I also missed the nuclear episodic pivots because of that, because I had just taken so many losses in CoreWeave as well as Pony. I tried getting in Pony as well after its on its earnings. It had formed a little flag. So I missed the initial run up in the nuclear names because I was protecting myself from myself. I mean, obviously in hindsight, I should have taken all the nuclear names. I should have taken CoreWeave again because I would have made a lot of money. And that would have been great, but it's more important to me. I'd rather miss out on those gains than have a large drawdown, because what if CoreWeave did? What if it stopped me out again? What if the nuclear EP failed? Right? I mean, because obviously in hindsight it all worked, but in real time I don't know if that breakout's going to work, and I cannot put on the added risk. If you lose 6 trades in a row and you're trying to put size in, like there's no way you're not on tilt. I mean, there's absolutely no way you're mentally sound enough to be able to make decisions, especially putting on more risk. It's just not a good idea. So at that point I was like, I have to slow down and start over. So then I started over, small size, waited for A+ setups, waited for my my bread and butter, and then I'm able to continue trading because I kept the drawdown under control.
Yeah, and I think that's perfect. And this year, obviously the index has gone really well since the correction, but there was a choppy period where I know my trades weren't really working too well in later May to June timeframe. I couldn't get too much traction going. It improved a little bit after, but there's periods like that where there's the initial push off where the leaders expand, and then it gets choppy. And if you're not positioned earlier or in the right frame of mind, that's where you can give a lot back if you didn't have that cushion, or just not trade well and suffer a drawdown that sets you back mentally. And like you said, sizing down for you, those themes worked out at that instance, but maybe also you wouldn't have been in the frame of mind to execute properly like you can in those themes. So I think that's perfect.
Right.
One question I did have, starting from a correction, a few trades work. Are you selling those trades outright to then finance other positions, or like a Palantir, are you just kind of holding it and watching your open gains and seeing if it's worth adding risk on, and you're keeping track of it mentally that you're seeing good progress? I think that's a big question to have. Do you have to sell a winning position to finance other ones, or can you kind of use the open profits to finance new ones?
Right. So this is I can go back to the slide about right. So this is the trick, right? Do you want to lock in profits to put on more trades, or how aggressive do you want to be with that open risk, with that heat, right? So that's a personal preference. It depends so much on the stock. So with Palantir, if it didn't have earnings, so I sold my Palantir position before earnings. I wasn't going to hold through that event risk, but if it didn't have earnings, I would have held. I mean, I like to think I would have held. I mean, I sold, but I probably would have held. I mean, this comes down to the trader. I do have positions that are still running that I've held for over a month. Yeah, I mean, I'm not really sure how to answer that. I mean, yeah, I mean, I will if I think it's a new bull market, and my positions are showing me progress. I will try to hold at least some of them for the rally. I mean, for sure. Some traders prefer locking in the profits and then using that to find that open or that closed profit to finance risk in other positions. So I mean, it's such a personal decision on your preference, your risk tolerance, your drawdown, what you're willing to accept in terms of giving back your heat or your open P&L. But yeah, I mean, at the start of a bull market, you really want to hold on to those positions if you can.
If you get them. And you did have that QQQ position that you sold, and that allowed you to finance some risk that way with those profits.
I mean, it feels like I lost on that trade even though I won, but yeah, that did lock in some profit, yes.
So were you trying that a few times during the correction process as we kind of put in an upside reversal that looked like it could be an extension low, or
No.
that was the first time you tried it? Okay.
I mean, I never play bottoms. That's the first time I've ever played a bottom because it was just so extreme. I mean, I think it was 3-4% gaps in a row, but that is not the way I trade normally. I mean, I buy names at highs. That's not how I trade. It was just such an extreme moment. And I remember I was gripped by, I mean, I missed the entire sell-off. I mean, I was in cash or short of a few names, but I missed it. But I remember just feeling this like gripping fear. I mean, this incredible feeling of uncertainty. And I remember thinking to myself, like, you're in cash. Like, what are you terrified of? Like, what? Yeah, you're fine. You're protected. But it was just, this market gripping fear. The headlines were negative. I mean, futures limit down, and I was like, geez, you have Palantir selling off right into the 150 day. If it's gonna, this is the spot to play a balance. If you're ever gonna try buying the bottom, right? If you're ever gonna, this is the spot. I look back at the COVID crash, right? And Tesla got supported as 200 day, I believe, in a similar kind of situation. So I use that as my precedent. But yeah.
Yeah, excellent. And then I want to see, going back to kind of poker, what's kind of a similar analogy to progressive exposure? Is it like building up your stack of chips before you're getting too aggressive and just, like you said, folding hands when it's not a sure thing, or not, the probabilities aren't really in your favor? What's kind of similar with poker to this concept?
Right. So poker is more that. So I'll use a hypothetical example. You have a $100,000 bankroll. You play 10-20 no limit with a max buy-in of $2,000. Okay. So you're risking, when you sit down at the table, you're risking 2% of your total bankroll. Okay. That would be the equivalent in poker. You have guys with a $100,000 bankroll sitting down with $100,000 in a high stakes game of, say, 50, 100 or 200, 400. They put the entire bankroll on the table. That's not, that is literally all in on, in one trade, risking your entire account. Those guys can go on massive runs, but as you can imagine, they always give it back. They always give it back. There's just no risk management. When I was in college, Rounders, I don't know if you watch Rounders, but that was like one of my favorite movies. But Mike McDermott, he's the perfect example of, he literally put his entire account in one game, and he lost. He lost it all. The opening scene is he literally loses everything he had. So, and then at the end of the movie, he risks everything he had and potentially his life if he loses. Right. So I actually had a slide about him. About how he wouldn't make it as a trader, because if you keep taking these all or nothing bets, eventually even if you're a 99% favorite, if you take thousands of trades, eventually you're going to lose. You're going to lose everything. So yeah, that's the equivalent for poker with trading.
Excellent. And could you go to the slide that compares heat with risk, if you don't mind? Because I thought this was interesting. Because for me, the bigger drawdowns for me are when I've got a sizable position. Maybe I've got 3, 15, 20% positions in leaders, and it's coming off the top of profits, but it still hurts quite a bit.
Right.
So how do you compare progressive exposure and just risk management when you're first starting positions versus when they've been trending, they've been doing well, they're just they're acting fine, but then they start pulling in off the top, because obviously to keep the monthly drawdowns, you don't want to give too much back, and sometimes even a pullback to the 21 EMA, which is completely normal in a trend, is pretty sizable in some of these higher ADR leader names. So how do you kind of think about that to keep those monthly drawdowns and overall drawdowns within the parameters that you're looking for?
Right. So in that kind of scenario, so I look at the percentage extended from the moving average. So each stock has its own character in terms of how extended it'll get. But if it gets really extended from the 21 EMA, then I'll sell. I'll sell some or most to prevent that kind of equity give back. But so again, this depends on the trader. Some guys, to them it's like it's open P&L. They're willing. It's not risk to their initial risk. It's open P&L. They're willing to risk that to make more, right? And if you go back and study like the late 90s, some of these names, they just keep going. They pull back. They'll have these really fast 25% pullbacks to the 21 EMA, go sideways for a week or two, and then launch and double again. So it obviously there's no guarantee that's going to happen, and that might be the time when it sells off and forms a longer base. But it depends so much on the trader. That's a great position to be in, right? To be in 3 leaders, great open profit. You have the flexibility to choose what you want to do. If you want to take some profits, reduce risk, reduce heat, and try to play for a bigger move. It depends. Minervini, he'll just sell. He'll just lock in the profits and take it. Other traders, they have a longer time frame. They're willing to give back that P&L. This is something you have to discover for yourself what you're okay with. And if you want the best of both worlds, you can sell half, take half, and let the other half ride. It really depends on the trader. I tend to sell. I'll sell more. I mean, it's very hard for me to hold to the 21 EMA, so I'll sell more. I'll sell 70, 80, 90% of the position when it gets really extended from the moving averages.
Yeah, and I know you did some research, looking at your actual entries and how your performance compared to if you held to the 21 EMA. Can you talk about that process a little bit? Because I think that's a great exercise for traders out there as they're discovering, what their sell rules should be. Do they want to completely let it pull back, or are they better off like selling more into strength? And it does depend on how much you're willing to give back and all that. But yeah, could you talk about that research you did?
Sure. Yeah. So I simply looked at all my trades from last year and just changed the exit to a close below the 21 EMA. Like that was the exit, right? And it like more than doubled my results. Of course, you don't. It's one thing. It's kind of like looking at a chart, right, and saying, you should buy here and sell here. Okay, obviously, but you don't deal with the emotions on the way up. The equity give back, the open P&L give back, would have been immense at some points. And can you? So in the past, I did hold to the 50-day. I told that story in the other interview where I had VIPs, and I was in 10 stocks. They all stopped out except that one. It pulled right back to the 50-day and bounced, and then I like the pain was too much. All those other losses like kind of accumulated, and I was like, I just can't deal with this. I'm just going to get out, and I didn't, and I sold it, and it would have kept going. So this is something you have to decide for yourself. What you can emotionally handle, right? So is it superior to hold to the 21 EMA? Like I think it is. Based on my results, when I go back and look at my years of trading, if I held to the 21 EMA, my profits would have been significantly higher. But having the ability to do it is challenging, especially because I size large. I want to have size on in my A setups and in my names that move, and that makes it more difficult. So, one thing I could do is size smaller initially or sell 80, 90% and hold a small chunk to the 21 EMA. That's one solution for me.
Yeah, and we also discussed last year, which I think is really important to talk about. Last year was a really nice trending year. During some years, it might be better to sell more to strength. It's more like coming up with a process that works with you, works with how, if you can stomach larger drawdown, maybe you hold more to the 21 EMA and try to let that trend work. Right. But like you said, it's about knowing yourself, knowing what you can handle, and yeah, it impacts your psyche, all these drawdowns, because like you said, it happens in all your stocks all at once. It doesn't just happen in one stock, and you can be really objective. If you're feeling heat, you're feeling it on your entire portfolio and all that. Yeah,
absolutely. And I also want to say, if you really want to zoom out and look, so if I held to the 21 EMA, right, my results, let's say I did that, and last year I was up 800%, right? Well, the previous few years, there are some years where I was, maybe slightly up or break even, but if I held to the 21 EMA, I would have been down 20%, right? So because, sometimes the rallies, they fizzle out, and the 21 EMA is an inferior exit to the selling into strength. But over the long run, it's better, by far, it's better. So are you willing to potentially have, say 4 years, right? 100% return, 0 plus 20, or plus 400% return, minus 10, minus 10, minus 10. So to give you an example of the potential changes in results. Obviously, the plus 400 with the small losses is way better, but emotionally dealing with that is a whole other thing. I'm human. I would like to win every year. I want to win every year, and if I had to sacrifice returns for 1 year in order to be positive every year, I would do that, even though it's obviously worse. At the end of all of that, your dollar amount's less, but emotionally, and psychologically, you can handle it better.
And doing what you do allows you to stay in the game versus whether you're willing to give those drawdowns, you're increasing the risk of ruin, increase the big drawdowns, which can knock you out, and then you're not able to trade for 10, 15, get that longer term compounding that is the ultimate goal.
Right. Yeah. At the end of the day, it's a personal thing. You have to decide what's appropriate for you, and the goal is to compound. The goal is to become at least for me, is you want to have financial freedom. You want to be able to provide for the ones you care about. And yeah, I mean, and then long term, if you really make it, you can do to help. I would love to be able to help more people. But that's a longer term goal. But those are all things that again, that's why at the start I talked about
Your why.
The why is so important, because if you don't have a really powerful why, it's going to be hard to survive through the adversity, because trading it's really tough. I'm going to refer to my friend again who's been transitioning from poker to trading, and I remember he would tell me, hey, why aren't you running 5 strategies? Why aren't you always in the market? You're leaving money on the table. Why don't you trade crypto as 24/7? And I'm like, dude, like what are you talking about? Like, that's crazy. I mean, it's like I want to be in cash. I don't want to constantly have positions on. I mean, it's like the stress. And now this year he's done fantastically well. After, I mean, he's a crazy boom and buster as well. And then this year he gets it. Like, he finally gets it. And he's told me, wow, like you're right. Like, it's the stress, like the mental fatigue from holding large positions and letting them trend. Like, it's taxing. So he gets it now.
Is he trading a similar way, or is he using other strategies?
Yes, he trades a similar way. He trades more aggressively than I do.
Yeah. What's that process like, do you think, transitioning from poker to trader? Is there a lot of new stuff that you have to learn, or it seems like he's picked up it relatively quickly? Obviously, he's got the benefit of getting to chat with you, who's gone through that same process, but I can imagine it's tough, but there's also probably a lot of helpful things that poker teaches you that translate well.
Right. So I think I mentioned this in the interview before, but the big thing with poker is that anytime you have an edge, you have to maximize it. You have to go for it any chance you can. You have to be extremely aggressive when you see the opportunity. So, you obviously are extremely willing to take risk, and when you see an opportunity, you are just aggressively pyramid. So he has that, and I always told him, look, he didn't realize how much of a strength that is. That most traders are risk averse, because most of the guys like him blow up, and he's blown up multiple times, right? So the big thing with poker is the aggression. I think the winning poker players are extremely aggressive. You just have to be. You cannot sit back and be passive in poker. You have to be aggressive. You have to win pots when you have draws and you don't have the best hand. You can't just sit back and wait for the nuts. So definitely the aggression and the risk taking, but you have to control it, right? And he didn't control it. He would start losing and he'd go on tilt and he'd increase his size, and then he could blow up in like a week. I mean, trading crypto on leverage and some of those like bucket shops, I mean, you could blow up real fast. So for him, I always told him, look, if you can learn to control the drawdowns, like the sky's the limit. It's just you have to do it. Like, I can't sit there and make you control yourself. Like, you have to be the one. Like, you're clicking the buttons, not me, right? Like, you have to control it. Otherwise, you're just going to be in this endless cycle of boom and bust, boom and bust, boom and bust. Yeah.
What was kind of your initial advice to him about risk management, setting stops, all of that? How is risk management different in trading versus poker, and what kind of adjustments do you need to make?
Right. So first off, when I told my friends I was going to switch from poker to trading, they thought I was crazy. Like what are you doing? Like, you're a great player. You've done extremely well. Why? I'm like, well, I don't want to be sitting at a computer clicking the mouse 100 times a minute for the next 20 plus years. I love the markets. I love the freedom, the flexibility, the time. I mean, the time is huge. I mean, time is the most valuable thing you have. And I wanted to be able to spend time with my children. So my why was I wanted to have the freedom to spend time with my kids when they're young. Because 95% of the time you spend with your kids is before they turn 18. Which is sad, but it's like, but it's the truth. I want to spend time with them while I still can. So that was a very powerful why for me to make that transition, because you go from being an expert at something to being a total beginner, right? I mean, obviously some of the skills help, but it's a huge pill to swallow. It's a massive pill to swallow, ego pill. I mean, your ego, you go from being an expert to being a total beginner, right? So, but in terms of risk management, I mean, poker has that, I think, I'm trying to remember, I think you want to have ideally 100 buy-ins for whatever stake you play. So if you play 10-20 and the buy-in's $2,000, you want to have 100 buy-ins. So you want to have what you want to have $200,000. I mean, that's in general. Now, if you're aggressive, you can try to move up stakes with 50 buy-ins or 20 buy-ins. But if you're going to move up with only 20 buy-ins, so that'd be $40,000 at 10-20. You want to be very quick to drop down if you start losing. So that's something that poker players really struggle with, because as you move up stakes in poker, the players get tougher. Like the pros, the higher you go, the better the pros are. So, but you want to level up. You want to play, you want to play in bigger games and make more money, but you deal with tougher competition. So it's very common when players would try to move up, they would get knocked back down because the pros are tougher. You're not used to the aggression at the higher stakes. So, going back and forth between stakes is very common as players are trying to transition and move up, and that's something I've experienced with my trading, is that as you win and your account grows, because I'm really trying to compound, is that the dollar amount gets bigger, and that increases the emotion and that increases the errors. So being able to control yourself when the dollar amount gets bigger, that's a whole nother skill that you kind of learn by doing. But I push myself. I try to push myself through the errors that I make and focus on the bigger goal of continuing to compound.
Are you focused much more when there's a potential trade? Are you much more focused on the risk side of things now versus the potential? Like nailing the entry. Obviously, that's part of risk management, but is risk management the focus now when you're trading?
Yes, I mean, I've been through a 60% plus drawdown. I never want to have that happen again. So yes, I am extremely focused on the risk. And like I said, where I had the core weave and pony trades where I got whacked, I mean, I could have very easily just kept sizing and going for it, and it would have worked out because it's a powerful market, and I would have gotten bailed out. But you are setting yourself up for a brutal drawdown when it doesn't work out, because if it doesn't work out, it can get very ugly. So it's very important, because the good times always end. Sadly, eventually there will be a bear market after a bull market, and when that happens, thankfully this last one, it was sharp and quick, and there weren't that many false. I don't think there were really any false rallies with leaders setting up, but there will be bear markets where you get multiple rallies where it looks like it's over and it's not, and everything fails. And if you get knocked out of those names and you see other names setting up, and you're like, okay, well, that was the bottom, it's time to go, and you size up, and then those fail, everything fails, and now, and that happens, 3, 4, 5, I mean, 2000 to 2003, there was like 10 plus rallies that all failed, and if you were just constantly sizing up, trying to cash the bottom, I mean, you got obliterated. So it's very important to think long term, and again, focus on the compounding aspect of it to keep the losses and drawdowns as small as possible.
Excellent. And can you go to the slide with the Mark Minervini quote about market wizard things? Because when I read this quote initially, obviously risk management is huge, and keeping small losses is definitely a market wizard thing. But it also reminded me of the work that you showcased in the previous podcast we did about studying leaders, and that helps just build the mental blueprint about how to manage a trade. What does a plus trade look like versus not? Do you want to talk a little bit about, or could you talk a little bit about how you organize things, what you've kind of studied that has helped your process and helped shorten the learning curve for you?
Sure. The big thing is going back and studying previous market leaders, because that gives you the confidence that they're always going to come back. There'll always be a leader, and then in a strong rally, you'll get multiple chances to make a return. It's not like, if you miss, Hood or Palantir at the start of the rally. I mean, obviously everyone wishes that they somehow caught it there, but if you don't, there's plenty of other stocks that will break out and go. And even if you missed, let's say you missed everything up to this point, okay? Well, guess what? A lot of these names haven't even formed a second stage base yet. Like, that was the first base. Now they double, and then they form the second stage base. And you could argue that next base will actually be easier because, take a stock like Rocket Lab, right? It's gone. I mean, it's doubled from its base. The next base it forms, it's going to be at all-time highs, okay? There's going to be no overhead supply. So it's much more likely you get a smoother breakout that time. So going back and studying history and realizing these moves, they last for a very long time, and there's lots of chances to get on board, and you don't need to be in a rush. You don't need to feel FOMO. The opportunities will always be there. And let's say you miss this rally, and then they set up again, and you miss that one too. Well, there'll be another one. The guys were asking me the other day about CoreWeave. Like, you missed CoreWeave, and I'm like, yeah. The worst thing is to be super bullish, have conviction in a name, and it's not even missing it, but losing money on it. And missing it, right? Like, how does it get any worse than that? But I'm like, look, it's okay. There'll be another CoreWeave. There will be another. I have theories on this rally, but I think it's gonna get. I think it's gonna be like the late '90s. I really do. I think there's gonna be just unbelievable opportunity in the next few years. So there's gonna be plenty of chances to get it back up to the plate and take swings, and you just have to connect with a few, and you can have a great return.
Excellent. And just to bring it back to progressive exposure risk management and to summarize a little bit, it's basically bending with the punches, sizing up when trades are working. You said 2 to 4, you'll size up a little bit or to the max parameter that you have. And then similarly, when maybe the market's not right, maybe you're just not right, when you start seeing trades not work out, you're sizing down a little bit. And also, it seemed like it's not just your trading, it's also a holistic view. What is stuff on your watch list doing? What are leaders doing in the market? Taking into account that. Is that a good summary of kind of the key points that you want to share with people today?
Yes, definitely. Yes. So, if for instance, like today, there's a lot of speculative stuff. I haven't looked at the market in the last 30 minutes, but there's a lot of speculative names, breaking out and going today. So that would give me more, I don't know if conviction is the right word, but yeah, it's more conviction that the breakouts are that there's still risk on, basically, right? Yep. Yeah, but what your summary was very accurate. Yes.
Excellent. Any other key takeaways or just general advice that you think you'd like to leave everybody watching here today with, and any last guidance or key points about risk management or progressive exposure?
Yeah, it would be with the compounding, just that keep a long-term view of things and realize that I think that a 25% CAGR, while challenging, this is not easy, right? But it's attainable, and you can see if you can maintain that consistency and longevity, that the returns are phenomenal, right? Like don't be in a rush, don't worry. If you have the discipline and the patience, it'll work out. It'll work out. And you can see the long-term returns of what's possible. Oh, and I also wanted to point out that I don't know if I did. The trailing 20-year CAGR for the QQQ is 15%.
Mm-hmm.
The trailing 20-year CAGR for SPY is 13%. Will that sustain? Maybe that's a bit elevated, but that's still those are fantastic numbers, and you can see the power of just investing in the Qs. So if trading's not for you, you got the Qs to buy, and if you hold it for 30 years, maybe it's not 15%, maybe it's 10%, but still every dollar becomes 17, and you get the advantage of compounding without paying tax, and it's a long-term capital gain. So there's that as well.
Excellent. Yeah, be involved somehow, whether it's trading or investing.
Oh yeah, there's a great analogy.
Yeah.
Sorry to interrupt you, Richard, but
Please.
It's I can't remember where I saw this, but my kid loves playing Monopoly, and I had I'm trying to teach him about investing and the power of compounding and investing, and I can't remember where I read this, but basically not investing is like playing Monopoly and not buying any property. It's like you just go around and collect your $200 every game. Now, obviously, life, Monopoly is not life. You can't win at life. You can win. Winning at life is getting what you want out of life. That's winning, right? Whatever that may be. Maybe for some people, it's like I just want to play tennis twice a week. I love being able to. Maybe some people, I want to retire early. Maybe I want to be able to spend more time with my kids. I want to, whatever it is, right? But investing gives you the potential to have financial freedom and to be able to live a more fulfilling life. So that's something that I try to pass on to them.
Yeah, I think that's a beautiful message. Chris, thank you so much for your time. Appreciate it. I definitely recommend to everybody watch our previous podcast. We'll probably link it down below. Really excellent stuff going through his trades and process and deep into a lot of the concepts we talked about today. We'll link that down below. But I hope you guys enjoyed. Leave a like if you did. And we'll be right back with the next presenter. And Chris, thank you again for your time, and we'll see you guys in the next one. Cheers.